Is it time to go to cash? In this video, we are going to talk multiple reasons why there could actually be a case for building a cash position despite stocks continuously hitting all-time highs. Or maybe I should say, in spite of. Anyway, let's get right into it. First, take a peek at this. This is a piece from marketeer.com. This is not sponsored, but what we see in this particular chart is a tech rally that begins here at the end of 2022, mostly because we're in what I call an EPS hole. This is when earnings per share at companies like Nvidia, AMD, Microsoft, you name it, have all gone negative. You're actually in what we call an earnings recession. Tech was in its earnings recession at the end of 2022, and that's fantastic because it gave a lot of people the opportunity to buy the dip. The question is, has that dip now rallied and is it time to move on to potentially cash? Or do you move on to interest rate sensitive stocks? Well, that's what we're going to analyze and price out in this video. One of the particular stocks that I'm paying attention to heavily is, of course, Nvidia, because if you look at Nvidia's forward growth, and I really want to warn folks about at least what the Wall Street expectations are on a forward peg basis. I briefly touched on this in a Tesla video yesterday, but I wanted to be clear where this is coming from. January 2024, the earnings per share for Nvidia were expected to be $12.08. January of 2025, so basically the end of 2024, right? We're expecting earnings to be $24.50. That's fantastic. That's a double. Why would we not love that Nvidia is doubling its earnings per share? Well, because the stock market pulls this crap forward. And the growth after this is expected to be 18.5 for the year ending January 26, 9.6 thereafter, negative 2.1 thereafter, negative 7.9 thereafter. And if you add these numbers together, divide them by 4, you get a growth rate of between 4 to 5%. Well, if I take today's price and I divide it by those forward earnings, I get a PE ratio of 34.8% for Nvidia. And if I divide that by just a measly 4% growth, I'm getting, 4 to 5%, I'm getting a 7 to 8 PEG ratio on this company. That's a sign of what happens, basically, when stocks moon on this kind of activity, but then you end up getting stuck with some flatness. This is likely to happen across the board. In fact, it already is. Take a peek at this. This blue chart is the spread between year-on-year quarterly growth. So looking at, let's say, Q4 to Q4 22, Q4 23, right? Comparing those quarters for that Magnificent 7 versus the other 493 stocks in the S&P 500. What you're going to find is the outperformance of the Magnificent 7 was remarkable at the beginning of 2023, but it's almost non-existent now. If anything, it's actually trending back to the hell that we were in 2022. That's a red flag. Now, here's an example of Apple having its third consecutive weekly close below its 200-day moving average and its lowest price since early November, despite everything else seemingly skyrocketing, or at least that's what it feels like when we're looking at indices. See, remember Michael Burry's warning that indexation can lead to a bizarre allocation of stocks, and boy, that allocation is moving rampantly. Now, Michael Burry suggested that would lead to a misvaluation in underlying stocks and an eventual crash, and I think we have to be balanced here and say, that didn't happen. We didn't end up getting some broad market collapse because of indexation. So maybe Michael Burry's just wrong then, or was wrong then and still is now. But I will tell you, these inflows into semiconductor indices, if you haven't heard of them, the Shake My Head and the SOX, Shake My Shocks, and I'm just making those up. These are semiconductor indices. These right here are showing you inflows in millions of dollars. And you can see that our inflow level here on the right matches where we were at the end of 2021. That's when we were in the massive boom in November of 2021, the top, basically. Somewhat concerning, something to pay attention to. But don't just pay attention to that. Consider that the PE premium, so price to earnings, what is the price to earnings ratio of growth stocks divided by value stocks. And when you divide those, you usually get an average of a 57% premium for growth. That means if a value stock has a 15 PE ratio, you would end up having a growth stock at a 23 PE. Or if the value is at 10, then the growth would be at 15.7, right? Okay, the average is 57. Right now, folks, we're sitting at 89%. We have not sat at 89%. Actually, 89% was over here. We've actually come down a little bit. We've come down to 89%. But we did just tick for a brief period of time before Q4 earnings came out. We were actually at a premium of about 120%, which the only time we've seen that was back in the dot-com bubble. Now, in fairness, the reason it came back down to 89% is because earnings did actually outperform. So we have to be careful. This is not a guaranteed hard and fast, oh, just because these charts don't look that great, the market's going to collapse. You have to be careful about running for the exits just because of this. But I'll tell you, it does feel like we've been facing panic buying. Look at this chart. Tech funds on track for nearly 99 billion in inflows in 2024. They write this cannot continue, unless, of course, this time is different. Nvidia is now worth more than a bunch of these different companies combined. The tree that reached the sky, Nvidia reached a $2 trillion market cap. In October 22, it was worth $280 billion. Cycles are much faster this time around compared to the tech bubble. You do not need a fancy detailed Excel spreadsheet to conclude that a lot is priced into that $2 trillion. And sometimes momentum bites you in the back. In the US, exposure to momentum is elevated, and lately there has been even more buying, particularly in late February. A 2 Sigma event. Oh, that sounds a lot like our friend Vlad. Oh, the impaler of stocks. High net flows have often coincided with the peaks in momentum performance, and yes, this factor is filled with all the hottest tech things. Okay, so let's consider this for a moment. There is a lot of cash on the sidelines. Yes, a lot of folks say, Kevin, there are $3 trillion of cash in money markets on the sidelines, and maybe that money's moving into tech. True. After all, if you're going to move to cash, what you're kind of thinking of is you're kind of like, I don't need another day or two of Nvidia's performance to get my 3 to 5%. I'll wait all year to get my 5%. Then, of course, the cash doesn't have the downside risk that potentially a stock does. But you have to be real. Nvidia's earnings, as an example, are really good. Nvidia makes about as much cash flow in a single business day as Square makes in an entire year. That's $100 million per business day. It's absolutely insane. In order for that to stop, you really need margins to collapse, and that's only going to happen when competition finally catches up. And even when competition catches up, you have to catch up with supply. So there's a lot of work to do here. Now, of course, some folks argue, well, maybe it's time to move from these stocks over into interest rate sensitives. But the problem with that expectation is you're making a bet that interest rate cuts are coming sooner rather than later. And as we talked about in yesterday's video and in yesterday's e-hack on the Fed, I'm not convinced that the Fed is actually ready to price in sooner rate cuts. If anything, it seems like they're expecting or trying to plant the seeds for later rate cuts. Consider what Raphael Bostic said yesterday. He suggested that after a third quarter rate cut, it would be time to pause. In other words, rather than saying, yes, we're going to cut, or rather than even saying, yes, we'll cut 3 times, he's like, hey, maybe after we cut in the third quarter, we'll pause. Now, he didn't say how many times, but this idea of a pause is yet another frustrating indicator of, are interest rate sensitive stocks just way too early? Is it better to take some tendies on some of the techs, sit in cash, and be ready to pull the trigger on interest rate sensitives as the time gets closer? I don't know the answers here. Goldman Sachs says this is all justified by valuations and this time is different. JP Morgan says there's a lot of froth in the market and you should be careful. I'm curious to see what you think. Personally, I never think it's unprudent to increase your allocation to cash slightly, especially if you could do so in an ETF structure. Hopefully in the future, many more people have access to that because then you can take profits pay no taxes and move to cash. It's a crazy tax hack. Anyway, if you want more kind of real, functional, practical hacks, make sure to join us at our Millionaire Symposium, June 21 to 23rd. It is an event we're holding in Vegas. It's expected to be the greatest, biggest, hugest finance event of the year, and it's inspired by just that, wanting to put on the best possible event for the YouTube community. So check it out at meetkevin.com. Thanks for watching. Goodbye.